It definitely is an interesting time in private equity markets. There's no shortage of interest. And Hayfin Capital Management, a household name in private debt over the past few years, started a capital solutions product for private equity. And I'm thrilled to say that joining me is the lead of that solution, Mirja Lehmler-Brown. Mirja, you're a partner and MD at Hayfin. First of all, thank you so much for joining.
Thank you.
So the past end of 2019 really has been remarkable. A lot of risk on optimism. You have the phase one trade agreement, the UK election out of the way. Does this give you some confidence for the private equity space heading into 2020?
Well, we see lots of inflows into the private equity industry during 2019, and with that added liquidity, clearly we live in a high price environment, and we expect that to continue. That makes us, however, disciplined in what we're doing and trying to be very mindful around the manager that we're working with.
So higher prices then obviously means lower expected return. So can managers actually live up to the expectations of investors?
So what they need to do is very much adjust their value creation strategies from just looking at financial metrics and operational metrics as efficiency. They very much need to incorporate growth in what they do, and they have been doing so for a while, and that goes across the board. So their strategies need to be linked into finding thematic segments that are showing growth. And if you look at the companies that they're working with, they very much need to invest in the business models in these companies to allow them to grow.
What are those thematic investments then?
So if you look, there's much more capital going into the software side of things, also into wellness or aging population. So we see an increasing amount of the capital going into healthcare related topics.
Healthcare, that's more of sort of a defensive play then. How popular are defensives right now?
They are very popular. Again, linking it into, even if the risks seem to be on and liquidity is increasing, we live in a cyclical world, and at some point some kind of correction is coming. And clearly in the UK, but also in Germany, there are issues, shall we say, from the top-down perspective. And with that, resilience are sought in business model much more than on average.
I feel like that's a really interesting play you're talking about, because you see on one hand, okay, we need higher returns because there's more money, but investors are a little nervous. There are more risks out there. So how do you sort of get the growth out of these companies when there are so many macro risks out there?
No, A is linking to, if you buy a company that's growing already, I mean, we live in a low growth environment, they ought to do something right. And then if you then invest in the technology so they can be more efficient, in R&D so they can come up and increase the productivity of the R&D, and if you invest in the talent, which means that you can get more out of the business itself, then you spur on the growth. If you look at the private equity model, on average, you tend to want to double the EBITDA over, let's say, a 5-year period. In a high growth environment, it could even be that when you exit, the exit multiple is going to be lower. That means that you even need to overcompensate and more than double the EBITDA in order for you to achieve the target returns that private equity still is trying to achieve, at least in the middle market.
So Morgan Stanley Wealth Management did come out with a note earlier this month, essentially saying that, look, we're at peak private equity, the days of double-digit returns are over. Are they correct?
No, not in my view. We are focusing on the mid-market, where we see more flexibility and where pricing is high, but you've got more room depending on what areas you're looking at. So we very much still are targeting high double-digit returns and find opportunities across Europe and across sector in order for us to keep on achieving that for our clients.
Well, speaking of investor expectations, I know that's something that you look for your managers to do, or meet different ESG parameters. What's the idea behind that? Is that because it's added alpha, or is it just to do good?
No, I do think that the new ESG or sustainability way of investing is actually you recognize you can have both. You don't need to choose anymore. You can have sustainability and profitability. Indeed, if you link back to what I said, you really need to build a better business in order to achieve a higher price for it. And ESG is very much ensuring that you build a better business. I mean, from the risk perspective, keeping it clean from an environmental, governance and social side, but also if you look at an S, employee engagement, a high employee engagement is a positive thing. That's also along the S spectrum of ESG in your toolkit.
Right. Well, Mirja, I happen to know you also practice what you preach. I know you took public transportation here to reduce emissions, so certainly living up to that ESG model.